RegA Plus, Real Estate and Beyond. I want to thank our sponsor, Nuvei, payment provider to some of the world's leading brands. I'm Peter Daneyko. I'll be from KoreConX, and I'll be your host today, and at least for the next hour. And I want to start with, let's start with the beginning. The industry is maturing since the Jobs Act was signed into law in 2012. And with it, the rules, technology, and the processes for legal compliance and marketing, they're evolving, I think, in 2023. Andrew, you might correct me and Nate, if not, but I think we had over 327 RegA filings. So it's a growing industry. It's still in the early stages, though. It takes a team for a successful capital raise. And today's panel of experts are colleagues of mine that I've worked with in the past, and I mean true experts. They help prepare and optimize raise efficiently and compliantly, and with a special focus in the real estate section for today. From the regulatory filing and legal preparation side of the world, I'd like to welcome Nate Dodson, who heads up Crowdfund Lawyers, securities and investment firm with an extensive background in real estate. So welcome aboard, Nate. I see our other panelists joining us right now. So I'm going to jump over we'll give him a minute to come on board. While we're waiting for that, I'd also, on our panel in front of us, I'd like to introduce Andrew Korn, CEO of E5A Integrated Marketing. Hey, Andrew, great to see you again. A leading investor acquisition and marketing firm with significant real estate and financial marketing expertise. So this is going to be a really enjoyable session in a panel with the two of you here. We have Andrew Stephenson with CrowdCheck Law, Chief Product Officer and partner at CrowdCheck Law. And he's been working in the RegA space almost since the inception. And we're just waiting for Andrew to jump in here. But respectful to our audience for the next hour, we're going to start to jump in a little bit here. And I'll do my little bit of a preamble or a bit of a primer on the RegA. And then we're going to turn over to our panelists here. So always like to start with the primer on the regulation as such at the high level. So it's evolving over the last 12 months. RegA Plus is now, it's evolved over the last 12 months, but it's now set up to $75 million in capital that you can raise. It's open for general solicitation to the public. We'll discuss what that means. It's a qualified offering with the SEC, and it's often referred to as a mini IPO. There's a myriad of options on how from the legal perspective on how that's structured for debt or equity. And I'm going to leave that to the legal folks on the panel here to dive deep in, and I won't overstep my legal skis. So from that perspective, let's just give Andrew Stephenson just a minute to kind of jump in with us. I saw him show up, and sometimes, as we all know with tech, it takes a second just to get the mics and the cameras going with that. So we'll give him a bit of a breather there.
Can I already disagree with you?
What's that? What did we miss?
This is going to be fun.
Oh my God. So I'm the non-lawyer here, but calling it a mini IPO, it is a public offering of private securities. It is not anything like an IPO.
Appropriate. I'll use the colloquialism, and I'm going to have the lawyers give us the details specific on that.
I would love for the lawyers to give us the details.
Well, we can always start there and then uplist to an exchange. So it may be a precursor of that public offering, but you are correct. It is still private securities at the end of the day.
Private securities and perfect. And that's why we have the legal panel. Andrew Stephenson from CrowdCheck Law, welcome, and thank you for joining us.
Yeah, sorry for the delay there. Airbnb just didn't want to sync up with the camera and microphone. But,
hey, anytime we can get four guys in a room and handle the tech this efficiently, I think we're going to be in good shape. So,
yeah.
So okay, we've already kind of jumped in. I did this kind of mess up a little bit. We call it a mini IPO, but you guys are the RegA guys. So let's just jump right into the pre-raise side of it, the legal planning. And I'm going to pass it over to Andrew and Nate, and let's do a deeper dive in the filing requirements and what a RegA Plus offering is, and why, in my humble opinion, it's probably one of the best exemptions out there for companies to raise private capital. So who wants to begin? Andrew, do you want to just jump in and talk a little bit about, okay, what is a Reg A plus offering?
Sure. I mean, we can always sort of start from the beginning in U.S. federal security laws that all offers and sales of securities must be registered or exempt. And registration is, that's your traditional IPO. That's or if it's underwritten or just going, so doing that, putting together that massive prospective disclosure, getting ready and being prepared to do ongoing reporting under the Securities Exchange Act. And that's just too much for most companies. And so that's why there are lots of exemptions available. And the most commonly used exemption is Rule 506, sales to accredited investors, which is sort of built on the private sale exemption, statutory exemption. But Reg A is sort of the SEC's main exemption for larger sales of securities to non-accredited investors when not going through the full registration process. So and which is where I think, and I kind of heard the discussion of, is mini IPO a misnomer? And it definitely is a little bit, because IPO has some of that context of there's an investment bank involved. There's somebody who's kind of leading leading the underwriting, which doesn't really exist in Reg A. But even the SEC has used the term mini IPO in reference to Reg A, because it is a public offering of securities, and it does require public disclosures that go on file with the SEC. They get reviewed by the SEC, and all that needs to happen prior to being able to make any sales to investors. It wasn't not quite the response to the question, but I can.
No,
Nate wants to jump in. Yeah,
I think it's perfect. Yeah,
I would love to jump in, and at the end of the day, and for anybody that's listening, I mean, if you're trying to raise a large amount of money, beyond $5 million, south of or at $75 million, Reg A is a much easier way to go about it. The Reg D, as Andrew brought up, you can raise money, but it's primarily from accredited investors, about 10% of America, give or take. Where Reg A, all of a sudden, you're expanding that potential net of investors to capture the other 90% of anybody that you got to be at least 18 years old. But beyond that, really anybody can invest into Regulation A, and it can be marketed out to the world. So anybody that is social media savvy or marketing savvy, or want to hire a great marketer like Andrew Korn here, it's definitely a great way to be able to kind of reach those higher limits of capitalization.
Well, I'm going to dovetail right to Andrew on that, because you just said the marketing side of it and general solicitation. So the whole concept, again, and we think about accredited, non-accredited investors, is that ability for anybody to participate. So Andrew Stephenson made a comment of 10%. Andrew Korn, you're really pretty deep dive analytics guy when it comes to, especially on the real estate offering, looking at the number of investors on Reg A offerings that you're currently participating in. So dive into that a little bit when it comes to the numbers a bit and the general solicitation and what it really affords to companies.
Sure. So I'm going to hit it a couple of different ways. And let's start with, I'm not an attorney, nor am I an investment banker, meaning someone with a Series 79. But I've been around the block several times. And so, yes, I would say between 10 and 11 million people are accredited. I am not part of the mass affluent, nor am I accredited. I'm actually a qualified investor. And that's yet another designation. And when we are soliciting, we'll generally be soliciting, and this is going to sound a little crazy because it's not, the whole concept of crowdfunding being democratizing is just not true. Because although it's open to anyone, you're asking people to put money into something that's generally illiquid for an undetermined amount of time. So it is going to be people with disposable income. And we generally will target older, meaning not 18, and also more affluent. not people who were generally not working. Although it's funny, we have all of our own first-party data and are continuously building it. And our largest data set are people who are not working, who are recently retired, because a lot of the benefits of real estate is income. So there we are targeting people who don't fit the household income profile of other people we might be targeting. So I know I'm kind of running around this. And then I just wanted to talk about structuring for a minute and then bring this back to the attorneys so they can say, I've got this right or I've got this wrong. We love to run a 506C Reg D in parallel with identical terms to a Reg A plus. The only difference is share price. And again, part of it's not really democratized. People who are going to put in larger amounts of money who are accredited will get a slightly better deal. All the rest of the terms are the same. And that way you can actually raise, let's say, $200 million, where 75 of it is in the Reg A and the rest is in the Reg D. And that is something that then opens this up to even more real estate issuers. And I'd love to check with Nate and Andrew if what I just said is fairly accurate.
I'd love to respond, and it makes sense. It sounds like you're still targeting the higher net worth individuals. I couldn't agree more that being able to leverage the general solicitation type exemptions like regulation crowdfunding, like regulation A, in conjunction with a 506C, you are absolutely casting that big net. And it makes a lot of sense to have those terms with the Reg D, with the higher minimum investments. We do also have clients that have 50,000 plus investors, with the average investment being more like $2,000 to $5,000 each. And so it does take it out of that high net worth target to a lower, larger base target. They're still bringing in huge amounts of money, but they're also leveraging, we've got this deal for the high net worth accredited investors, that deal available to the masses.
Yeah, I mean, let me weigh in a little bit on that because, hey, it's obviously the larger amounts coming in makes it easier, but you're still, and the ability to do general solicitation. But I'm seeing a significant uptick in some real estate where companies might do a CF, they go to a Reg A. They're doing the lift with small investors because they did the right marketing, though. They did an audience and they did that $500 investor who's learning, they're becoming educated. So I do like the concept of democratization. It doesn't mean that, hey, just because you're doing a capital raise that every young person out there, but it's going to grow. I mean, I have a 21-year-old daughter. She starts to see these panels. She goes, hey, I like this. What is that? Explain that. You mean I could put $500 and own a piece of something? So that conversation starts it, and the technology and the exemption is the facilitator along with the marketers. So I would never, any of our listeners to go, hey, wait a sec. I'm only going after this. That may be the sweet spot, but to Nate's comment, it is to me, it's the democratization when it says anybody can participate. Doesn't mean you're going to get them all. So don't just assume that you have to educate them. And that's probably the key jumping off point. Had a question.
I'd love to respond to that.
Sure.
Because I also have daughters, and I'll never forget the first time I put them into a real estate Reg A, and I said, you fill out the whole thing, I'll give you the $500. And they both did it. And I'm like, so how do you like it? Because after 2 or 3 months, now they've been getting monthly distributions. And they're like, oh, well, it's a really good deal. I mean, it's in this case, it was an 8% deal, but delivering 12.
Okay.
But that's 1% of $500, basically $5 a month. So she's like, yay, I got $5 into my checking account. I see that it arrived. So there's some practical things about how much money you should invest to make it worthwhile. And that's part of the education with investors is, are you looking to pay your cell phone bill as a, for instance? Oh, well, yours is a full family and it's $300. How much money do I need to invest to get $300 a month? so that ends up getting some people to put in more substantial amounts of money. But that experience with our kids, I think, is really important of what expectations people have and then what is actually delivered on that.
And it's that jumping off in that starting point. Some of my kids are great savers and one of them is not necessarily a great saver. So it's that educationally getting in the habit. Some are going, hey, this is perfect. Some says, I don't want to deal with stocks in the public market, but I sure like the opportunity of maybe investing in real estate they're executing. And we're going to talk about that right now. We're going to jump in and I want to ask Andrew Stephenson and Nate and everybody on the panel here, but what are the different types of I hear the different types of structure. I hear things like Series LLC, I hear dividends, I hear debt, I hear equity. Give me an idea of what your experience, what seems favorable, what's working, because again, it's a myriad of all different asset classes in the real estate space as well. So, Andrew,
the different types of company will kind of depend on what is the model of the business. Are you operating more as a pooled as a vehicle that's going to be holding multiple real estate assets, so in a pooled fund? In that structure, then maybe using whether REIT or a corporate, or whether an LLC or corporation, but something that is probably that would be eligible for the REIT taxation treatment, just because that's something that investors are looking for. If you are wanting to give investors the opportunity to invest in single properties, so that their economic interest is just as tied to solely to the performance of one particular piece of property, that's where a Series LLC structure can be useful. And the alternative is for that is just separate LLCs entirely. But Series LLCs are convenient in the way that the sort of state Series LLC law interacts with federal securities law. And sort of forming a Delaware Series LLC, and sort of when correctly operating that with each series with separate books and records, each series is treated as a separate company in terms of protection of assets. So a creditor to Series 2 cannot get at Series 1 if Series 2 owes money to that person. But when it comes to the SEC, they treat series more just like separate classes of securities rather than separate companies entirely. And so that allows for a little bit of a faster process of getting those new offerings and new series and properties through the SEC review process. But really that only applies if you're giving investors the opportunity to invest into, if you really want to separate out properties into individual series that investors are sort of tying their fortunes to the performance of that property. That's when the Series LLC comes in play. Otherwise, you're looking at a sort of pooled fund, something that in a way that would qualify for REIT tax treatment.
Okay, so for clarity, just for my visualization, I want to buy, I'm going to raise up to 75 million, and I have an interest in 10 $7 million properties. Mm-hmm. I can make each property available to that individual investor, as you say, almost like a different class of shares, and I can say I want to invest in this one, a fraction of this one, and a fraction of this one. So mm-hmm. that gives me tremendous flexibility as an investor to at least choose in that environment.
That's right. Yeah. So investors could sort of kind of create their own portfolio of what of how they're touching different types of real estate, rather than just putting all their eggs into a basket of a diversified fund. And you're still, in some ways, you're still relying on the management, but it's sort of property by property rather than just being in one large pool.
Okay. Nate, what are you seeing out there? And then we'll jump over to Andrew on some live cases right now that he's working on.
I do love the series model. I refer to it as the new syndication model. A lot of our clients have a massive amount of experience doing syndications, buying real estate on a property by property basis. Traditionally, they've been mostly targeting the accredited investors. This is really just kind of the ability to up their game, especially right now it is a little bit more difficult to raise capital from accredited investors. So again, kind of going the route of Regulation A versus the traditional Regulation D, we'll be able to cast that bigger net, bring in more capital from more people, but still they're really not changing their business model. They're still acquiring property by property, deal by deal for the investors. Now all of a sudden they can just do it on a grander scale with the Regulation A.
Okay. Andrew Korn, as a tech provider, having had the pleasure of working with you on what I'm viewing as maybe one of the most successful raises I've seen in a long time. I mean, the company's doing multiple raises from a RegA perspective, but walk the listeners through. It was a journey. Like, it's not like, hey, put up your website, they will come. You articulated to me a great story about a snowball effect at one time, and maybe I think that's
so. It is. I mean, basically, you're going through the normal branding and acquisition process that you would for any product or service. Real estate has an advantage over some other offerings where it's usually something physical. So it may be an office building, it may be self-storage, it may be multifamily. In the case that Peter's talking about, they're hotels. So that gives the marketing team, wow, we can actually photograph something, and we can do a video walkthrough, and we can interview, we can show staff, and we can show customers potentially. So having it be real definitely makes a big difference. But I talk about the snowball because it's very different than Reg CF and also like Kickstarter, where that first week is the most important, where we say the first week is the least important. We're not expecting a flurry of money to come in unless you've got a bunch of investors who are waiting. So I describe it as a snowball because it starts very small, and every time it turns, it's gathering more snow. And then it just gets bigger and bigger and bigger. And then when it turns, in our final month of this last raise, the issuer, which we support the issuer, we do not raise capital. We're an advertising agency, or in our case, a systematic data-driven investor acquisition firm. But over $11 million was raised in the final month, and they exceeded their $50 million goal by quite a bit and ended up having to update their paperwork. And now running into their next raise, we're having a phenomenal first month. Although I don't know if the issuer would agree, but compared to other first months in Reg A, it's going to be very strong because we've got all the data and the audience, and we've basically proven to people, well, first, for millions of people, they've gotten to know the issuer because they've seen the ads. Then even a smaller subset of that has gone and looked at the offering. And then a smaller subset of that has gone in and looked at what does it look like to invest? And a smaller subset has become investors. And when you look at month 1 versus month 12, the average dollar amount invested has gone up in a very linear fashion, similar to literally rolling a snowball. It starts off a snowball and it ends up the size of the bottom of your snowman.
Well, and it sounds like
with the snow analogies. So.
It's based on trust. I mean, trust and execution. So in that example, it was a dividend. It's one thing for me to say I'm targeting 8, 10, 12% dividends in whatever I'm doing in my real estate project. When I start to execute, it also gives me the flexibility to continue to raise capital. So remember Reg A Plus, I've got 12-month window, and a lot of companies, it's just, I'm going to do another Reg A Plus. And I'm just noticing a question here, and Andrew Stephenson, you can probably pick this up, it says, is each series LLC its own Reg A or have its own limits?
Yeah, so when filing with the SEC as a series LLC, the master LLC is sort of identified as the issuer. So that's the one that has the EGR profile, the EGR account, and who's the sort of the named entity on the offering statement. And then each series is underneath that entity. So all the series together are going to be aggregated for that $75 million 12-month limit. So that's how you look at that. So it would be aggregated all together rather than $75 million per series. Looks like there was another question on that came in about switching from tier 2 to tier 1. And while you can switch from tier 1 to tier 2, so you start in the tier 1 process, you're going through both state review and SEC review. You decide you want to go to tier 2, you can then amend your offering statement under tier 2 and then complete just the SEC review. You can't go the other way. Well, I suppose you could go the other way, but it's not going to be a quick transition. Essentially, it's going to be like starting over. Because when you start with tier 2, you're going out with sort of preemption of state registration. And so if you start bringing in money, in particular, you probably wouldn't be able to switch over to tier 1. But if you haven't sold anything yet, you decide, you know what, okay, maybe we don't want some of these additional burdens of tier 2. Only tier 2 requires ongoing reporting, for instance. Don't let the audited financial statement requirement trick you. That's a red herring. While in tier 1, it's not required by the SEC unless you have them. But the majority of states require audited financial statements. So if you have audited financial statements, then you have to provide them. So you still have audited financial statement requirements whether you do tier 1 or tier 2. But you can't go. But if you start tier 2, if you haven't done any sales, you could potentially amend and just be tier 1. But if you've done any sales, then you're locked into tier 2.
Okay, so let's address the real practicalities of tier 1 and tier 2. 99% of what I'm seeing is tier 2, because if I'm doing general solicitation and whoever wants to pick up the ball on blue sky filings, I've suddenly limited, for me to actually do general solicitation to everybody in the United States, and I'm doing a tier 1, what are the limitations there? And when I have to do the state filings, don't my costs at the end of the day almost get me to the same place, except I've kind of handcuffed myself? Nate, Andrew?
Definitely takes a lot more cost, a lot more time, a lot more waste. You can, at least under Reg D Rule 504, raise up to $10 million. You still got to deal with the state level registration issues. So it's really, I see tier 1 as being, well, I'm trying to raise $10 to $20 million. There's generally alternatives like doing a 506c in the states that you just don't want to deal with the registration process at the state level. And then getting beyond that, I start talking about the tier 2 nonetheless anyways.
Mm-hmm.
So Andrew, you work with the tier 2s, Andrew Stephenson, the blue sky filings and all of that stuff as a firm, right? Is that what's your experience there?
Yeah, no, definitely. And I think we've only done one tier 1 in the past, and it just ended up being much more work. Okay. While the state regulators have a coordinated review process, it's still the timeline on the review is still uncertain, and you don't know when you're going to get through it. You can get comments that can between regulators that conflict. And again, I think another area that is also a bit of a red herring is that some states then will require ongoing reporting. They have their own reporting requirements. So you don't get out. So you don't necessarily get too many benefits out of it. You also have the states have a patchwork of when you can start communicating. If you're doing a 50-state offering under tier 1, you have some states that say, well, you have to have your offering information on file with the state for at least 21 days before you can even make an offer. So not an offer for sale, but just to make an offer. Whereas some state, and so it's a little bit. So there's just a lot more sitting on your hands with the state review process. With tier 2, you can get through that, and with using the testing the waters with that state preemption, and you're just dealing with notice filings with the states rather than registration filings.
Okay, so I'm going to turn this over to Andrew because he's the guy that's, if you're doing general solicitation and I suddenly say, hey, wait a minute here, I'm in New York and I can't transact, I kind of just took a lot of the gravy off the potatoes, so to speak.
Yeah, so, well, first of all, I am very grateful that I am a guest of Facebook in their Chicago office today and speaking to you from there. Anyway, the whole thing about tier one and not having audited financials, you're not going to be a client of my agency if you don't have audited financials. So the reason that we get involved in deal structuring, and then of course the lawyers do what they do and do so well. Two of the best firms here with us right now, is that issuers want to know from us, what do you think is going to work? And what are people looking for? And it shouldn't be reversed. I mean, an offering should be the offering that they are planning on. But if you are doing an offering that is going to have delayed current income, or if you're doing an offering that is not going to have any income, these are all tremendous considerations when it comes to the marketing. And we like to get involved early, generally before the paperwork is done, and have those conversations with the issuer and with the lawyers, so that we're all on the same page and that we don't get handed an OC where we don't believe we can actually market it. So that's kind of where that gets involved.
You just led me right into one of the questions I'm looking at here is timelines, both from a legal and when should marketing actually commence. Timelines I hear, and I've seen fully qualified RegA offerings as little as 4 months and as long as 12 plus months. Nate and Andrew, what's the reasoning, and explain the whole qualification process and the holdups, and no comments.
Well, I'd love to just chime in, because we've definitely seen some of the timelines take a little bit longer. It generally takes a month, give or take, to get everything together to actually file with the SEC. And we like to take a lot of time on the front end, really to exactly what Mr. Korn was saying. I mean, we want to make sure that it's marketable, that it makes sense, that it hits the client's goals. That at the end of the day is the most important thing, before even saying RegA Plus is the direction that you want to go. It may be, a Reg CF or Reg D may make more sense. Until you really dive into goals, you don't really know. But assuming that you get it filed in a month, definitely have had filings come back in 2.5 months from beginning to qualification, but it comes back with this no review letter saying, yeah, we're not taking the time to look at it. That is happening less and less frequently right now. Fortunately, unfortunately, however you want to look at it, the SEC has been hiring for the RegA review process. And so it is taking a little bit longer, but at least the SEC is diving in. One of the biggest issues that one client that we inherited dealing with right now is they got a no review letter when they first got qualified. Now we're helping out with their annual filings, and the SEC is saying, well, now we're going to review, and now we have all of these comments going all the way back to the beginning.
Yeah. Andrew Stephenson,
comments on that? Say absolutely. Yeah, we saw. Yeah, and during the SPAC boom, that was when we saw a lot of no reviews, because the examiners were more focused there, because that was in their sort of assessment of risk into the market. SPACs, they needed to spend the time on the SPACs. But now we're seeing that. But there's definitely a refocus on RegA, and we're seeing comments that sort of based on disclosures that as Nate said, have always been there. So now it's like, oh, why is this an issue now? And then how do we make sure to get that things are still moving forward for the company, and there would be no reason to have to rescind anything that occurred. We also see a lot more comment. There's also a lot of scrutiny on if you're doing something that is innovative. If it's just a plain old common stock offering, you're an operating company, you're selling widgets, and you have contracts with suppliers to make, is in the extent of your material contracts or contracts with suppliers to make the widgets. It's pretty clean. You're gonna get through. Real estate and some very basic real estate ownership probably gonna be a little bit similar. But but part of RegA and some of the fun of it is that RegA allows for communicating with your potential investors in a way that is not possible with a registered offering. And you can do things that are different in sort of opening it up in a way that is that's also not something that is for that traditional institutional investors would like. But some of those schemes schemes may be the wrong word, but some of those structures are things that the SEC is like, what's going on here? We see this in real estate that is trying to also be like, so for instance, also try to give sort of help with home ownership. The SEC is not. They have a lot of questions on how those structures work, what it means for investors coming in, and so there are a lot. So some of those comment process and review times can get it really extended. And yeah, we used to start for most of the history of sort of kind of RegA since Tier 2 became possible. It was typically be 12 to 20 comments. Now we're seeing 30 more regularly as there is that increased focus and increased scrutiny of RegA offerings.
So that'll certainly delay things. And I guess the more creative or unique you get, the flexibilities get creative and unique, but also be prepared that you could open yourself up for a lot of comments. But at least it facilitates that ability to be creative. So it sounds like very specifically too when it comes to the marketing, and the marketing should begin at least earlier, or certainly by the time you start your filing, so you've got some momentum going on. You don't want to just filing, here I'm ready to go, let's start our marketing. You've kind of lost a lot of energy unless you've got an existing large audience that you know you're going to draw upon.
And even then, you need all your ducks in a row. You need your invest button set up. You need your transfer agent. You need your escrow. You need all that stuff done. And for people to access it and know it, you need marketing. We tend to look for 60 days to set up a large-scale RegA, and we've done it in less. And part of that is understanding the investor journey and things that could be ready that you don't need literally day one. You may need at the end of week one, but not much later. And then I just want to address the more complexity in the offering, the more difficult it is to explain to a stranger who you will never be in the same room with. So it does make the marketing job a little bit more complex, and it might make, let's say, all that in the simplification, it's all done extremely well. It may take more than one visit for them to understand it, which may mean the date of first contact to date of them investing, a slightly longer time frame. Now, over the course of a year, that may not make a very big difference, but issuers are looking to recycle money coming in and putting some of that back towards marketing. They may need a little bit more capital up front so that there's plenty of money for paid media to make sure we're not going to run out of money before enough money has come in to replenish those coffers. So
we're gonna touch on budgets for both of those things. Somebody made a note to me earlier that, what does all this cost? But prior to that, and I appreciate, Andrew, you bringing up a point from a planning perspective. It's not a linear process of doing, I'm going to do my legal, then I'm going to talk to my marketing agency, then I'm going to talk to my tech platform. Oh, by the way, the tech platform, Peter, I know you guys can turn around in 2 weeks an invest button in the tech that's compliant. I go, yeah, what I can do technology-wise, I can turn around relatively quick, but I have to set you up with everything else you need from an administrative perspective, which is the escrow, which is the transfer agent, which is the payment rails. All of those intermediaries to connect so that you can actually transact, they take time. So you can't just wait, or all of a sudden, and I say this to our audience, it's not uncommon. And I know our product dev team goes crazy because people go, hey, I'm ready to go live. They've engaged us. And we go, what do you mean you're ready to go live? And they said, I've got qualified on my RegA offering. And we're going, okay, but you don't have TA and you don't have the rest of it. So from a regulatory perspective, you need to know what are all the intermediaries and the participants that you need to enable to transact.
I have a quick question, actually, for the attorneys. If someone does what Peter just described, isn't that an SEC violation if they can't take money in within 24 hours of them being qualified?
You get 48. You get 2 days. You have to be able to accept sales within 48 hours of qualification, and that's one of the limitations on RegA is that it does not allow for delayed offerings. So you can't use it like a shelf. It can't be out there and then, hey, we're going to start accepting funds when we're ready. When you qualify, you don't want to qualify until you are ready to go. So you're in control of that qualification date. You get to say, all right, if you need additional time to do some pre-qualification marketing, additional time to do some other sorts of build out on the offering platform, that should all be done ahead, but before of when you request qualification.
No, and thank you for that. And I may exaggerate a little bit, but it sure seems like I wanted it tomorrow and I've got everything done. And often it is just one piece, like, oh, I'm waiting for my paperwork back, which might happen today. But everybody has to plan. And I think the issuers have to understand that just because you're ready today, if you don't let everybody do their job, doesn't mean that they stop everything for your raise because everyone's dealing with multiple accounts at the same time. So everybody it's a team.
We use a lot of generative AI in our work, but we can't create your offering page and your ads in a day. And I have heard from issuers, particularly of late, we're waiting for our qualifications before we select a marketing agency, which is kind of not the right process.
And I think that's what we're all saying here. Do things synergistically, plan up front, measure. Let's jump into budgeting a little bit here. I want to raise $75 million. I want to be realistic, marketing-wise. Andrew Korn, give me some benchmarks.
So it's not something that a startup can do. It needs to be a firm with some fairly deep pockets or they're going to run into trouble. So it is possible that every dollar raised can then be put back into marketing. But what I always say is, what if we can see all the KPIs and measurements or all our ducks are in a row, but the money's not really quite flowing in yet, and you run out of money? If you run out of money, then every dollar you've spent was just wasted, as opposed to you had enough money in the bank that we can get it over the goal line and boom, we're going to end up raising the 75 million. Odds are when we present a budget at the end of the 75, it will be darn close to what we estimated. But those first 3 months, there's a lot of testing, measuring, refining, optimizing going on, and finding all the right audiences and seeing how long it takes from the time of first ad impression until they decide that they're going to make that investment. And the REIT that we just completed, 44% of everyone who invested reinvested, and a substantial amount of money. So obviously that didn't happen in the first few months. So we recommend having between $500,000 and $750,000 in the bank so that you can get that done. Most of that is going to paid media, not to our services, although certainly our services are a substantial amount of money because we're building everything up front before we even show the first ad to somebody.
So you got to have a budget at the end of the day. A nice thing.
I just gave you one.
Yeah. No. I'm agreeing with you. I'm agreeing with you on that. It's just to everybody.
I've seen it happen after $80, $90, $100,000 spent in media. I've seen it take the full 700 before we saw the snowball big enough that you could perceive it with your eyes without having to look through, a magnifying glass
and get the
exponential.
Yeah,
and not only is every offering different and every issuer different, but when are you doing it? We will not launch between November 15th and January 1st because, we're not going to fight the holiday season. So there's timing involved, and we love early January launches because we've got all the way basically till 4th of July. Schools are out, et cetera. So much of this is seasonal. But what we saw in 2021 was not the same as 2022, not the same as 2023. And, I don't know what 2024 is going to be like, other than we are so much better at our job now than we were 2 years ago, because it's a young industry and we've learned and we've built new tools, and more than anything, we've built our own data. But that's no guarantee. There are no guarantees in marketing.
Well, you made a comment on reinvestment too, and from a technology perspective, the ease with which your early investors can reinvest by having compliant ways to capture that individual's information and that data, so that so they're not going through that process again. It's a pretty quick process, because the nice thing about RegA offering, there's self-accreditation. So I just tell you what my income is, and it's going to calculate what percentage that you can invest in relationship to that particular offering. I make $100,000, and Nate and Andrew, it's approximately 10% of my annual income or my net worth, whatever the higher of the two is. And that formula is factored in there, but the investor doesn't have to worry about that. So if I fill in my first 4 pages and I'm done, it's just basically my personal information and compliance related information for ID verification, anti-money laundering, KYC. And that lends something to everybody here. Is I get the question often, they go, hey, so I just paid with my credit card. When do I get my shares? There's a process. This is a security, a digital security. Know your customer, ID verification has to be done. And that's done on you, the investor. So any investors that are out there, or companies understanding that investor's journey. From there, the funds are going into escrow. A broker dealer is going to help facilitate those funds coming out of escrow by basically doing a compliance exercise, that making sure that the ID verification, the KYC and anti-money laundering had been done. Technology is facilitating this. So it's not like e-commerce where the funds go in on that credit card and they're going right to my bank. They're going into escrow, and they have something that's often used as rolling closes. So a rolling close, and Andrew, your firm's experienced it. At the end of the month, you may say, I'm consolidating how much money come in, and I'm allocating a portion of that money to continue with my marketing efforts. So yes, you have to have a budgetary planning to say how much am I going to spend on marketing. But as you're getting successful, you do have the ability for use of proceeds to continue with your marketing, and obviously the marketing firms will gladly assist you with how to appropriately budget those kinds of numbers. There was a question.
2 cents on
Yeah,
that.
thank you
budgeting.
for that.
Because I think Andrew Korn just scared everybody, saying, well, I don't have $500,000 in cash just sitting in the bank. We've done a lot of RegAs for real estate, and I can tell you that very few of our clients had that kind of cash just sitting around waiting for the marketing. Without a doubt, the biggest heavy lifting and the biggest cost ends up being the marketing. But it's also, RegA is not for people, especially in the real estate space, that aren't professional investors, haven't been working in real estate, haven't been doing deals beforehand. This is not something to do your first deal with. And most of those guys either have a network, a investment community, a social media presence. We work with a lot of influencers. So, you're one of the best sayings of one of our clients is, your net worth is your network. And with the real estate investors, kind of the biggest incentive is the guys that have already been in the market. Doesn't matter if they have $500,000 in the bank or not, marketing absolutely ends up being one of the most expensive components at the end of the day. But as long as you have a community, a network, you're used to raising capital, just a budgetary number shouldn't be a reason to not move forward.
Yeah, and I should clarify, because if you're doing a RegA, your very first one, your cost of capital from a marketing perspective could be 4-5%, and 5% of $75 million is almost $4 million. So, we're talking about way, way, way more. You just don't need all that money at once. And then depending upon if you want to start slower, you can, and let that snowball build a little bit slower. And, we deploy almost all advertising through programmatic, which means every campaign is like a dimmer switch. We can turn it up or down based on KPIs. But the flip side of that same coin is, we love to go after the 75. So we can't start all that slow because there's an expiration date on this campaign. It's not like an exchange traded fund or a mutual fund. You could raise that over 5 years if you want. You can't do that. You've got 12 months to get it done. We practically have what we call a FOMO department at our agency, meaning fear of missing out, because you don't want most of the money coming in months 11 and 12. You want it coming in as fast as you can to get that snowball being moved. So what's it going to take to get people who have come and visited the offering 2 or 3 times already? What's going to get them over the hill? And we spend a lot of time focused on that. Anyway, but back to budget with it.
And what I'm hearing from both of you, though, and from our experience, look, we're the tech guys behind the scenes. We do the plumbing, so we see a lot of raises. We see highly successful raises, and we see very soft raises. It's the preparation and the planning and managing those expectations. I see companies that have a network and they're spending like this amount on marketing. They're rare though, because they have that network. And to Nate's comment, and they immediately jump in. They get a big lift because they have a community. I'll make it analogous in the e-commerce space or the retail space. Hey, if I build my store in the desert, it's going to cost me a lot more to get people to my store in the desert than it is if I'm on Madison Avenue, but Madison Avenue cost me a tremendous amount to put my shingle up because of the real estate cost up front. So in each case, low amount, it's just plan your budget, but budget something, and don't just jump into a RegA and said, I put it out there and I didn't plan my marketing spend. So I think that's what I'm hearing from both you guys is Andrew's going, you want 75 million, you're going to spend a big chunk of money. So you need a seed. And Nate, you're saying the same thing is what I'm hearing on that. Question back to Andrew Stephenson, and this was a little on the legal front. So somebody's in the middle of a RegA, and the client, the issuer says, I'm in the middle of a RegA, and I'm learning about this Series LLC. Can I, in the middle of a RegA, he goes, I'm doing an equity deal over here. We're a developer, and I've got the land development side of it, and then I've got different phases. And they're savvy guys, knowing, like, as far as they go, but can I do a debt instrument into my, basically it's kind of like 2 classes after I've already started my RegA? Can I go backwards to say, here's my RegA, I filed it this way. I also want to do another instrument inside of that, like a debt versus my equity over here. Can you go backwards and do that?
So the idea is it's the same issuer, but just offering two different classes of securities.
Two classes, but they're already live with the RegA filing, and they've been qualified for that offering.
Yeah, so they could add another class of securities through an amendment. So while that amendment is under review, it's going to be, because it's a fundamental change. You're adding a new class of securities. The offering would have to pause. So they'd have to sort of go back, so kind of cease taking new investors, go pause, go dark, or put up the testing the waters materials while you're back into SEC review for that additional class of securities, additional information, and so that would be one route to go. And I think in probably the is sort of in that scenario that you mentioned, where it's sort of it's one developer who's sponsoring this, that's probably the way to go. What wouldn't work as well, and it has more complications, would be trying to maybe set up a sort of an affiliate that's doing a raise for that other class of security. So you're not pausing the first RegA that's equity, but trying to do the debt through an affiliate that's going to be connected. That type of scenario is problematic because now you have to answer questions of is it a co-issuer situation? Is actually that new issuer connected in such a way that the business of that issuer is based on the success of the other one raising? That's a co-issuer situation. Now you're kind of back to square one. Or is it the SEC, and you also have the potential the SEC looks through the arrangement, says, hey, this is a single plan of financing. And so we're sort of aggregate and look at both of these together. And so it also gets you back to square one. So it would have to be a very different. So if it was a very different, so it could be an affiliate, but sort of a very different business that's doing that debt raise, you could sort of have them as separate tracks. Otherwise, you'd want to keep it a sort of one track through a post-qualification amendment. Adding that additional class of securities is something that was available to investors.
Okay. Thank you for that. So deeper dives required to see how they structured the deal originally. It may be possible, but it almost sounds like, again, plan up front with your lawyers. What's the structure of the company? What's the best way to facilitate this? Hey, maybe I want, but the beauty of it is I can have multiple classes of shares. That's the beautiful thing, especially for developers. How do you want to design your project and your offering? Because that may appeal to different audiences in a slightly different way. Or maybe I want to be part of the shovel in the ground, or I want to be part of something else further down. So question here that I wanted to have for everybody. So, okay, Nate, you brought up of things, multifamily, self-storage, affordable, or maybe Andrew did, and senior living. What's the appetite out there as far as the nice thing of RegA? You can kind of do anything, but what's your guys' experience been with the offerings that you've all been engaged with?
We're seeing still there are some multifamily that are getting funded. There are less of those today, kind of similar to the commercial office building areas. Yeah, there are some deals that are happening. They are less and less. Where we're seeing more and more traction is actually acquiring first lien debt. Because of kind of what's been going on with the interest rates, you're getting some deeper discounts on both performing and non-performing debts that are out there. So we're seeing that as being a kind of a more attractive area and getting a lot more focus on the real estate front.
Andrew Stephenson, anything unique or unique projects or?
Yeah, I think we're kind of still seeing the same. Seeing the same things out there. Project sponsors are it's whatever they have available. So sometimes if they're looking to make an acquisition, that becomes we don't see as many of those in the commercial space, just because commercial the kind of counterparties aren't selling. And so necessarily, so and so that gets a little bit trickier to get those into a deal. There's there are some I think probably the sort of the fastest one to get to market is single family homes that have been owner occupied. But again, it depends on what's going on with investors.
Easy to understand, right?
Exactly. I think there's the learning curve for an investor into that type of investment is simpler, and so there is some appetite for that type of market.
Okay.
So real estate is all local, and so if you're doing build to rent or if you're doing multifamily, it's easier if it's Texas and Florida because they have a net positive migration of people. It's kind of the back office states for California and New York for a lot of financial services, for instance, and people are moving there. So that is an easier story to tell than I want to build multifamily somewhere else, just like Nashville has become so popular and some other places in Tennessee. So as long as there's a story that is true and is compelling, then it can be marketed depending upon where, where it is. And sometimes when there's construction going on, there's lots of other stuff that it's going to be the anchor, and then these other things are going to sell as well. So the story is super important, but it requires data and backup, and most kinds of real estate we're seeing reasonable pickup on, except for office, of course.
And I agree with you, and I think and trust and common sense. I'm looking at a RegA offering this morning, live offering, and they're involved in commercial real estate, but in the sense of retirement facilities all across the country in different areas. It's just easy to understand. You said, hey, we got an aging population. You guys are building retirement facilities. You're going to offer a dividend. You guys are successful operators. I should get pretty jazzed about this, but at least jazzed enough to start. Look, they've got to earn my trust. They've got to present their materials on the offering page such that their story is told that I can understand. And it's not just put that offering page and expect that they're going to make an investment. Or, there's some of them are projects that might appeal to a completely different group. They might be beneficial to that community in low-income housing, for example. Like there is that emotional connection and that heart-tugging side of it. Or maybe it's a project that's involved with improving a community and the environment based on their dev project. Completely different audiences, but marketing firms like yourself and the firms out there, it's real. Like it's touching the right person so that they can have either a financial gains or something that pollinates with them that, hey, it's financial and I'm doing good. So there's all kinds of a myriad of things that I've seen that are successful, but it comes down to planning up front, getting your legal advice done right up front, getting your marketing team on board, and working with technology that hopefully makes it seamless and frictionless to you. So, gentlemen, I thank all of you. I want to close out on what's in the future. I'm hearing things in the real estate sector. We're seeing marketplaces. We're seeing platforms where companies are saying, I'm going to do lots of developments and I'm building my universe of investors and I want them to keep coming back. We'll start with you, Nate. Where do you see things going?
I see some turmoil of old deals coming up on the horizon as properties have to be refinanced, and that's going to create new opportunities. So in all the commercial, the multifamily, even the hospitality, as people are unable to, make sense of a refinance at the current interest rate levels, the carrying costs, we're going to see a whole new wave of deals coming onto the table that will make sense at these higher cap rates. And that I'm really excited for.
Andrew Stephenson.
Yeah, I think the kind of the X factor in RegA is at what point do sort of traditional sort of kind of big brokerages and institutional investors get in? And as to Andrew Kore's comment, those are the players that are going to really get those snowballs rolling. And so when that happens, the level of RegA activity will dramatically increase.
Well put. On that point, before I'm going to close with you, Andrew, even when companies also have to look at, you're putting your brand out there, you're putting your marketing out there. So you are coalescing what they say, hey, I'm raising capital, but I'm putting my story. I bring it up because I recall a particular very soft RegA raise, and it was in the tech space, and it was in the med tech space, and it was a complicated thing. And the VCs didn't want to touch it. They went through all the exercise of the RegA. They were spending a lot of money on the marketing side that didn't work. But lo and behold, that exposure got them into a family office that they never would have gotten that exposure, and came in and took out. They were fortunate, took out the whole deal. So you never know where strange things happen, but you have to put the effort in and work, and sometimes those bluebirds can come.
3 times we've had retail ads hit professional investors who have done $1 to $5 million in a single investment into a RegA and not asked for a side deal. Sometimes they'll ask for a side deal because they'll want slightly better terms than someone putting in $500. But part of our job is making lemonade out of lemons. And, if a deal is coming out at X% and that's what it's going to be paying, I think part of the marketing will be, part of that is due to interest rates. And think about a year from now when we've already paid down some of the equity because we're paying off our loan. And also interest rates will probably be lower. Think of what that will do for your return. So some of it is positioning, but the positioning, it's got to be real because they will actually have paid down some of their loan. And we don't know whether there'll still be interest rates at this level or not 12 months from now. So there we go.
Panel, I thank you. And our audience, I thank you. This will be re-recorded and everybody has the opportunity, will have the opportunity to share it again. KoreConX and our Core Summits will be continuing these, I think, next Wednesday and Thursday and throughout the month of November with various subject matters. So we invite everybody to participate. And we appreciate your comments and the time, the hour that you've given us today. So gentlemen, thank you. Always insightful. I learn something new every time we do these. So again, enjoy your day.
Thanks, Peter.
Thank you.
Guys.
Thanks so much. Take care.